We're going to talk a little bit about a price filtering technique which I call Bollinger boxes. It developed from point and figure charts, and I use it to filter prices in order to be able to recognize M's and W's and other price patterns as they're forming. It's literally a filter, a noise reduction system that helps you clarify what's going on. Filtering prices, obviously helpful. It educates the eye. It lets you understand what's going on. It reduces the noise. Percentage and point filters have been employed for many, many, many years. They're one of the oldest technical techniques. Go back into the literature of the teens and 20s and 30s, and people are already talking about price filters. Variable filters are better. This was discovered long ago. And the way it was discovered is the point and figure guys found out that you needed to use smaller boxes for a $5 stock than you needed to use for a $100 stock. So they changed the filter value based on the price of the stock. Smaller filter values for low price stocks, higher filter values for high price stocks. Volatility is a terrible filter. It filters out the signal, leaving only the noise. A fellow by the name of Robert Levy proved this in 1970 when he conducted a study of filtered prices. And he used volatility as a filter. And in a very elegant study, which he thought would prove that technical trading systems were useful, he proved that once you've used volatility as a filter, nothing works. All right? All that's left is noise. So do not, under any circumstances, use volatility as a filter. To give you an idea of what filtering means, I'm going to use this illustration of the NASDAQ composites. It's 3 years' worth of price action. It has no filter employed whatsoever. I'm going to start with a very small filter, and I'm going to increase the filter size, and we'll see what happens. So there's a very small filter. It's a 5% filter. I simply connect the highs and lows any time the move exceeds 5%. So if I come up to a high, I don't start drawing a downward line until I'm more than 5% off the high. If I come down to a low, I don't start drawing an upward line from that low until I'm more than 5% off the low. Here's what happens when you switch to a 10% filter. Look especially over on the right-hand side of the chart. You see that last big push up? It has 1, 2, 3, 4, 5 waves in it. Move to a 10% filter, and now it has 1 wave in it. So each time you increase the filter size, you decrease the noise and you decrease the number of swings, and you focus the eye more precisely on the price formation mechanism for a longer term, from a longer term view. So here's the 5% filter, 10% filter, 20% filter. Look what happened. Look at the central portion. It's now 1, 2, 3, 4, 5, 6, 7 swings. Go from 10% to 20%, 7 down to 1. Let's take it one more step, and we'll go to a 30% filter. Now the entire wave up is captured by one move, and there's one reaction that's significant on the decline. Finally, at a 40% filter, the entire move is composed of 2 swings. So depending upon our task and goal, we can specify a filter that shows us the moves that we are interested in. If we're interested in very short-term activity, this 5% filter is probably a good way of looking at the price structure. More intermediate term view, trying to capture the bigger swings, not so much worried about the chatter, 10% filter. Looking for only the really big moves, want to really isolate into the big bear swings and the big bull swings, a 20% filter, and so on and so forth. That's what filtering does for you. It forces you into the recognition of the major trend. You can use small filters or large filters to suit your trading style. Point and figures charts are nothing more than price filters. Here is a one-point chart. This is from Whelan, written in about 1914. Okay? So we're getting way back there. Now, look at the, see, even then he knew about filters. This is the price action using a one-point filter. This is the same chart using a three-point filter, and this is the same chart using a five-point filter. Right? So as you increase the filter size, you reduce it to the most elemental swings. Essentially, as you increase the filter size, you move up from the small trends to the intermediate term trends to the large term trends. Here's another example, again from Whelan, written about 1914, a 10-point chart using a 10-point filter on an item that's trading at about $2,600 at the beginning of the chart, and that same chart using a 20-point filter. So many of the whipsaws in here go away, and this just becomes a little consolidation zone. Same here. So it just cleans up the price action and forces the eye to recognize the trends. Here's a modern point and figure chart of IBM. The circles represent declining prices. The boxes represent increasing prices. The 2 that you see is the digit representing the number of the month. That was the first box that was drawn in February. The 3 would be the first box that was drawn in March. This would be the first box. The A is the first box that was drawn in October. The B would be the first box that was drawn in November, and then there was no box drawn in December. So the only reference to time on these charts is the time reference that you impose, because otherwise these are pure filtered price action. There's no reference to time. The swings merely denote that we reversed by more than the minimum filter amount to an upswing and back to a downswing, back to an upswing. Now, this is the Chartcraft scheme for box sizes. If a stock's below $5, we use boxes of 1/4 point. If it's between $5 and $20, we use boxes of a 1/2 point. Between 20 and 100, 1-point boxes, and above 100, 2-point boxes. So they made some recognition that, you know, we need to change the box size. But notice the tough changes in the box size. At $20, below $20, at $19.50, a 1/2 point makes a new box. So it's a 1/2 point filter. Above $20, all of a sudden we shift to a full point filter. Well, look at that. That's 5%, and that's 2.5%. So it's a really jagged shift. And you can see those shifts here where I plot the box sizes against price. So this is the box size as a percentage against price. So, for instance, at $5, we go from a 7% box one day to a 10% box the next day. At $20, we go from a 2.5% box to a 5% box. And at $100, we go from a 1% box to a 2% box. Big jumps. I think that's analytically a problem. So what I did is I curve fit, using a very simple mathematical curve fit, a power curve, I curve fit these structures, and I derived the formula for the curve. I did it for 5 different point and figure box size schemes, for Wheelan's, for Chartcraft, for AIQ, and 2 more that I can't remember off the top of my head. So I found that the formula for that line is the following. It's 1.166 times the last raised to the 0.52 power. Well, 0.52 power is almost the square root. It's almost sitting exactly on the square root. So why not simplify that formula? It's 17% of the square root of the last. That's a Bollinger box size. 17% of the square root of the last. So if we had $100 stock, the square root of 100 is 10. So 17% of 10 would be 1.7. So the box size using Bollinger boxes for $100 stock is 1.7. The wonderful thing about Bollinger boxes is that for every price, you can find a unique box size. So the price is continuous. The filtering is continuous. There's no jumps, there's no discontinuities, and boy, do you really need that when you're trying to sketch out the patterns. Let's go back here for a minute and look at our filter of the NASDAQ. We just take an intermediate term filter here. Here we draw and we see clearly, I believe that this is a W2. So with a filter, it becomes immediately apparent what the patterns are. This would be in M. I think it's in M16. It's my guess. I don't have the chart in front of me. I keep the chart on my desk. I don't have it memorized. But as you increase the filter size, notice that that M goes away. Right? So it's a very, very helpful tool when you're going after basic pattern recognition techniques. So here's some examples of percentage sizes for Bollinger boxes. At $4.50, a Bollinger box is roughly 8%. At $8, it's roughly 6%. At $18, it's roughly 4%. And at $69, it's 2%. So you can see that we have a curve here. As we get lower and lower in price, the box size gets larger and larger as a percent of price. Now that's a fact that can be checked, all right? Because all the way back in the 1930s, a fellow by the name of Frederick Macaulay, he's the inventor of the standard measure of bond volatility we know of as duration, bond duration. Before he did his work on bonds, which he became justly famous for, he had worked on equities. And he discovered something which today we call the square root rule. And he said that equity volatility was a function of the square root of the price of the equity. So you can check this. You can go back to Macaulay's work and use it as a check to see if our derived Bollinger box formula fits the theoretical model. So you have a check and balance here. And the answer is that the fit is almost perfect. It's a correlation in the very high 90s. So we have an independent verification that this model of volatility as a function of the square root of the price, which Macaulay suggested all the way back in the 1930s, does in fact fit our Bollinger box approach very well. So there's a there's a small way of saying thank you for coming to my seminar. The formula for Bollinger boxes, they're not out there really in any way. They can be very easily implemented in a spreadsheet, or if you can program in any of this easy language or metastock code. But there's the formula. By all means, stick with the simple one. Don't worry about the original curve fit formula. We use that in our office because we like to code. But the simplified formula works very well. Take it, apply it, and see if it doesn't help you filter out the noise and help recognize the price patterns as they're forming. Again, thank you very much for coming. I know it's been a long weekend, and I'm very proud of you as an audience for having stayed with me this long.